Walk into an RBC or a TD branch and ask for $20,000 of your own cash, and something happens that has nothing to do with the teller in front of you. Your name moves into a compliance system, a report can get filed on you, one you're not allowed to see, and one the person helping you at the counter isn't allowed to mention. Last year, Canadian banks and other reporting businesses filed 631,137 suspicious transaction reports to FINTRAC. Out of that pile, FINTRAC only turned around 1,783 of them into actual disclosures to police, a hit rate of roughly 1 in 350. That means the overwhelming majority of people flagged were never treated as real criminal cases. They were customers moving their own money, and one of the fastest ways to land in that pile is withdrawing a large amount of cash after 40 years of careful saving. Most people assume the line that gets you flagged is $10,000. It isn't. That number only triggers an automatic paperwork form, the kind a computer fills out without anyone blinking. The real risk sits inside a law called the Proceeds of Crime, Money Laundering, and Terrorist Financing Act. Under Section 8 of that act, a bank employee who even hints you've been reported can face up to 2 years in prison. That silence is the point. You can be watched and never know it. So today, we're looking at why a bank actually gets nervous about a $20,000 withdrawal. The exact phrasing that keeps you on the right side of that line, and the 90-day pension gap that opens up if your account ever gets closed over it. If you've spent decades building this money, and you're tired of being treated like a suspect for wanting to use it, stick around. The fix is simpler than the fear. What surprises most people is where the real risk actually sits. The $10,000 number everyone talks about belongs to something called a large cash transaction report, and it's almost entirely mechanical. Once a withdrawal or deposit crosses that line, the bank system generates the paperwork automatically and sends it along. Nobody makes a judgment call. It's closer to a customs form than an accusation. The real danger sits in a different document called a suspicious transaction report. There's no dollar minimum attached to it at all. A teller can file one on a $500 withdrawal if something about your behavior feels off to them, and they can just as easily leave a $20,000 withdrawal alone if you're calm, clear, and consistent. One report is a data entry task. The other is a judgment call made by someone in their 20s who has been trained hard to see risk everywhere. That difference is exactly why the old advice about keeping transactions small is actually the trap. If you take out $9,000 today and another $9,000 tomorrow specifically to stay under the $10,000 line, you haven't avoided attention. You've committed a federal offense called structuring, and it's one of the fastest ways a retiree ends up flagged. The moment you try to hide a transaction from the bank rather than simply explain it, you cross what I'd call the identity protection line. To a bank, a retiree buying a used camper is a customer. A retiree who looks like they're dodging a report gets treated like a money launderer, even if all they wanted was to skip a little paperwork. None of this means you did anything wrong. It means the system reacts to patterns, not people, and a retiree spending down decades of savings can look, on paper, exactly like someone trying to move money in secret. That's an uncomfortable irony, but understanding it is the first step to not becoming another number in the daily count. Do the math on how often this happens. 631,137 reports, filed in a single year, works out to roughly 1,729 Canadians flagged every single day. I used to tell people to just keep their withdrawals small and quiet to avoid the hassle. I was wrong about that, and I'll say so plainly. In today's environment, that advice is closer to a trigger than a shield. Here's what doesn't show up right away. Even when a report goes nowhere, it can sit in your file, and enough of them over time changes how a bank sees you as a customer. long before anyone says a word to your face. But what happens if the bank decides, rightly or wrongly, that you're simply too much of a compliance risk to keep as a client? For a retiree, losing the account isn't the worst part. The worst part is what it does to your pension deposit the following month. If a bank decides to end the relationship entirely, what actually happens is almost administrative. They mail you a bank draft for whatever balance is left and close the account. It sounds simple, almost boring. The part that isn't boring is what happens to the 2 or 3 deposits, your CPP, your OAS, maybe your GIS, that were set up to land in that account every month. Most people assume switching a pension deposit to a new account is a phone call and a form done the same day. It isn't. The default process to redirect CPP, OAS, and GIS payments to a new institution can take up to 90 days if you haven't already put an emergency redirect in place. The delay exists because those payments run through a direct deposit file that has to be manually updated on the government side once your old account closes without a forwarding instruction already attached. Nobody bridges that gap automatically. By default, you're the one who discovers it, usually after a payment has already gone missing. Run the numbers on what that actually costs. The average CPP payment sits around $925 a month. The maximum OAS payment this quarter is $742.31. Add those together, and you get roughly $1,667 a month in pension income at risk. Stretch that across a 90-day blackout, and you're looking at just over $5,000 in delayed income, while your property tax bill or your hydro bill doesn't pause to wait for Service Canada to catch up. Ask yourself honestly, if your account closed tomorrow, do you already know where that money would land instead? Most people don't, and that gap is exactly what turns a paperwork inconvenience into a real financial squeeze. I've talked to people who sat on hold with Service Canada for 2 hours, only to be told the update wouldn't take effect in time to catch the next payment cycle anyway. That's not a rare exception. That's closer to the default experience when you're trying to fix this after the account is already closed. The fix isn't complicated, but it has to happen before you need it. Never keep all of your liquidity inside one of the big 5 banks. A backup account at a provincially regulated credit union, somewhere like Vancity, Meridian, or Desjardins, gives you a second landing spot that isn't tied to the same federal compliance pressure your main bank operates under. Credit unions answer to different regulators than the banks that report to OSFI, and that difference in temperament is exactly what gives you room to breathe if your main account ever gets frozen or closed. So now you know what the blackout actually costs in real dollars, and where the second account needs to live before you ever need it. But there's a way to avoid triggering the blackout in the first place, and it has almost nothing to do with hiding your money. It has everything to do with who you talk to at the branch. There's a paradox worth sitting with here. It isn't cash itself that makes a bank nervous. It's cash they can't explain. A withdrawal with no context reads as a risk signal. The exact same withdrawal, with a little context attached ahead of time, reads as a normal Tuesday. That's why going around the teller line and talking directly to a branch manager changes the entire interaction. Someone in their 20s behind the counter has been trained hard to treat every large withdrawal as a potential compliance failure on their own record. A branch manager has more discretion, more experience, and more authority to simply document a transaction properly instead of escalating it. The conversation itself can be almost boringly simple. Call ahead or book a meeting and say something like, "I need to withdraw $20,000 next Thursday for a private purchase, and I have the bill of sale ready if your compliance team needs a copy for the file." That single sentence does more work than any amount of nervous explaining at the counter, because it hands the bank exactly what their own paperwork asks for, before they have to ask for it. Compare the two paths side by side. One retiree withdraws $9,500 today and another $9,500 tomorrow, avoids eye contact, and gets irritated when asked what the money is for. That account gets flagged for structuring, often within days. Another retiree calls ahead, brings a bill of sale for the car or the invoice for the renovation, and treats the compliance question as routine paperwork rather than an insult. That withdrawal usually clears without a single report ever being filed. The dollar amount is identical. The outcome is not. None of this is paranoia on the bank's part. In October 2024, TD Bank was hit with a $1.3 billion fine in US dollars from FinCEN in the United States for failing to catch money laundering moving through its accounts. Every Big Five bank in Canada watched that fine land, and every compliance department since has leaned harder toward reporting first and sorting out questions later. Your teller isn't being difficult by choice. They're working inside a system that just got a very expensive reminder of what happens when it looks the other way. So the system itself is shifting, and not just in how tellers behave at the counter. It's shifting in how much banks even want to deal with cash at all. It helps to compare where we are now to where things stood back in 2008. During the financial crisis, banks wanted your cash. Deposits were the thing keeping them stable, and a customer walking in with savings got treated like a lifeline. Fast forward to 2026, and the math has flipped. Every large cash transaction now carries a compliance cost attached to it, in staff time, in reporting obligations, in risk exposure, and for a bank, a customer who mostly uses cash has quietly become a net loss rather than a valued relationship. That shift didn't happen overnight, but it's the quiet backdrop behind every extra question you get asked at the counter now. Look at the trend line. According to Payments Canada, cash payment volume dropped by more than 40% between 2013 and 2018 alone, and that decline hasn't reversed. This isn't some hidden plan to eliminate cash. It's simpler and less dramatic than that. Maintaining the infrastructure and staff training required to handle a $20,000 cash withdrawal properly costs a bank more than the transaction is worth to them. So the customers who use cash the most become the customers banks would quietly prefer not to have. Picture a retiree at 64 selling the family home and moving to a smaller town. The sale closes and a $500,000 draft lands in their account. If they then try to pull out $30,000 in cash for moving costs and a few big purchases, they've just created exactly the pattern compliance software is built to catch: a large deposit followed quickly by a large cash withdrawal. Nothing about that is illegal. It's just the shape of a red flag, whether the money is dirty or not. I don't have a crystal ball, and I can't tell you whether Bill C-2 will pass in its current form or get watered down before it does. What I can tell you is that the cost of being a private, cash-using customer keeps climbing year over year, regardless of which government is in charge or which bill is sitting in front of Parliament. There's a specific feeling that shows up at the teller window, and it's worth naming because almost everyone has felt it. It's your money. You earned it over decades, you paid tax on it along the way, and some part of you thinks you shouldn't have to explain what you're doing with it to anyone. That feeling is completely normal, and it's also exactly what makes people act defensive in a moment that calls for the opposite. It feels like an interrogation because, in a small way, it is one. You've worked 40 years, raised a family, paid your taxes on time, and now a stranger behind a counter is asking why you want access to your own $20,000. Feeling insulted by that question is a reasonable reaction. Acting on that feeling at the counter is where things go wrong. Banks aren't measuring your character. Their systems measure behavior patterns, and irritation, hesitation, and vague answers all read as the same signal, whether or not you have anything to hide. The shift that actually protects you is small, but it matters. Instead of thinking, "This is none of your business," try shifting to, "I want to help you finish your paperwork so we both get through this afternoon without a headache." That's not submission, it's strategy. Being the calmest, easiest customer at the branch that day is the single best defense you have against ending up on the wrong side of a compliance report. Let's turn this into something you can actually do before you ever need it. The first move is opening a backup account at a local credit union, somewhere like Vancity, Meridian, or Desjardins, and keeping around $5,000 sitting in it. That account isn't for daily spending. It exists purely so you have somewhere for a pension deposit to land if your main bank account ever gets frozen or closed without warning. The second move takes 10 minutes, and most people skip it entirely. Log into your CRA My account and your Service Canada My account and confirm both logins are active, with your password recovery information current. If you ever need to redirect a payment in a hurry, fumbling to reset a forgotten login is the last thing you want standing between you and your pension deposit. The third move is building a paper trail before you ever need one, not after. If you sell a car for cash, get a signed bill of sale. If you receive an inheritance, keep the lawyer's letter that explains where the money came from. None of this is about proving your innocence. It's about handing the bank exactly what their own compliance process is looking for. So there's nothing left for anyone to guess about. The fourth move only applies if the worst happens and your account actually gets closed. Call the Service Canada Pension call center right away. The number is 1-800-277-9914 and specifically ask for an urgent payment destination change due to account closure. Saying those exact words moves your file into a faster queue than a general request to update your banking information would. You now have a real defense plan instead of just a bad feeling about the bank. But there's still one more thing worth clearing up, because you've probably heard a rumor or two about cash disappearing from Canada altogether. So this is the actual shape of what we've covered. Your bank was never afraid of your $20,000. It's afraid of a $1.3 billion fine landing on its own doorstep if it fails to ask the right questions at the right moment. Once you understand that, the whole interaction stops feeling personal. Show up prepared, be the easy, boringly transparent customer, and keep a backup account ready in case your pension ever needs somewhere else to land for 90 days. Don't let a compliance department you'll never meet quietly decide how your own retirement gets managed. If this helped you see the system a little more clearly, stick around for more of these breakdowns on keeping your money exactly where it belongs, in your hands. You've already done the hard part. You saved for decades and got yourself here. What's left now is the smart part, protecting what you built. I'll see you in the next one.